The Federal Reserve kept interest rates unchanged at 3.50% to 3.75%, which was exactly what markets expected. The real focus was never the rate decision itself. What mattered was the updated dot plot and the message Warsh delivered during his first major press conference as Fed chair. The new projections removed the final expected rate cut for 2026. Just a few months ago, policymakers were still signaling one reduction before year-end. Now that expectation has disappeared, and some officials are even projecting the possibility of higher rates in the future. On the surface, that looks clearly negative for precious metals. However, there is an important piece of context. These projections were created before the full impact of falling oil prices from the Iran peace agreement could be reflected in the data. The assumptions behind today's projections were built around a much higher energy price environment than the one markets are currently facing. By the time the next projections arrive, the inflation picture could look very different. Warsh himself avoided giving markets a clear roadmap. That was not an accident. Throughout his career, he has criticized the Fed's habit of guiding investors toward specific expectations. Instead of spelling out future rate moves, he emphasized flexibility and uncertainty. Unlike previous Fed leadership, he appears determined to keep markets guessing. For silver investors, several comments stood out. Warsh described inflation as persistent, acknowledged that lower oil prices could help reduce inflation pressures, and hinted that the Fed may continue shrinking its balance sheet. That last point may be the most important because tighter liquidity can create headwinds for real assets, even if interest rates remain unchanged. Looking ahead, three possible outcomes are developing. The first is a short-term hawkish reaction that pushes silver back toward support near $69. The second is a more neutral interpretation, where silver remains stable between $69 and $71, while investors wait for the next catalyst. The third, and potentially most bullish, is a realization that lower energy prices could weaken the inflation concerns driving today's hawkish projections, allowing silver to move toward the mid-70s and beyond. While everyone focuses on the Fed, the physical silver market remains the bigger story. Registered COMEX inventories are still being watched closely as delivery demand remains elevated. The gap between available physical metal and outstanding paper claims continues to attract attention from investors monitoring supply conditions. With first notice day approaching, physical demand could become the dominant factor in price action. What makes today's reaction interesting is that silver held near $70 despite facing one of the most hawkish Federal Reserve messages of the year. Earlier in 2026, Warsh's nomination alone triggered a major correction in the silver market. This time, despite the removal of expected rate cuts and tougher language from the Fed, silver remained resilient. That resilience suggests the market may be finding support from forces beyond monetary policy. Industrial demand remains strong, global supply challenges have not disappeared, and the broader structural deficit story remains intact. The world still consumes more silver than mines are producing, and that imbalance continues to support the long-term outlook. Over the coming days, investors should watch Treasury yields, the formal Iran agreement, oil prices, and developments in the physical silver market. Those factors may ultimately matter more than the headlines surrounding today's Fed meeting. Warsh delivered a hawkish message, but silver did not break. That may be one of the most important signals investors take away from this week. The monetary backdrop became more challenging, yet the physical story remains unchanged. As the next key events unfold, silver holders will soon discover which force is stronger. This is JHon Silver Update. Let me know your thoughts on the Fed decision and where you believe silver is headed next. Now let's move beyond the Federal Reserve and focus on the part of the silver market that many investors believe matters even more over the long term: physical supply. While headlines continue to focus on interest rates, there is another story developing behind the scenes that has been building for months. The amount of silver available for delivery inside the COMEX system remains a major point of attention as we move closer to the next delivery window. Current figures show that registered silver inventories remain far below the level of paper obligations connected to futures contracts. Registered metal is the category that can be delivered against contracts, and the ratio between available physical silver and paper claims remains extremely tight compared with historical norms. This matters because every delivery cycle creates a simple question: how many contract holders will choose to take physical silver rather than roll their positions forward or close them out? The answer to that question can significantly influence market sentiment. Delivery activity has been increasing over the past several years. More investors and institutions appear interested in securing physical metal rather than relying entirely on paper exposure. That trend has gradually increased pressure on available inventories and has become one of the most closely watched indicators in the silver market. Another important factor is that not all silver stored inside COMEX vaults is immediately available for delivery. A large portion belongs to investment funds or other owners who may have no intention of making that metal available. As a result, the true buffer of freely accessible silver may be smaller than headline inventory numbers suggest. This is where today's Fed meeting becomes relevant. One of the biggest risks heading into the meeting was the possibility of an extremely aggressive message that could have forced many speculative traders to exit silver positions before the upcoming delivery period. That did not happen. Yes, the Fed sounded firm. Yes, the projected rate path became more restrictive. But markets did not receive the kind of shock that would have triggered a mass liquidation of silver positions. As a result, a larger percentage of current open interest may remain active heading into first notice day than many analysts expected just a few weeks ago. Stepping back even further, it's important to remember what silver has already endured this year. The market experienced sharp corrections, inflation scares, geopolitical tensions, and dramatic shifts in Federal Reserve expectations. Yet despite all of that volatility, silver continues to trade well above major long-term support levels. That resilience is difficult to ignore. Markets that are fundamentally weak usually break when they receive bad news. Strong markets often absorb negative developments and refuse to collapse. Many silver investors view today's reaction through that lens. The broader supply-demand picture also remains largely unchanged. Industrial consumption continues to expand across sectors such as solar energy, artificial intelligence infrastructure, semiconductors, electric vehicles, defense technologies, and advanced electronics. At the same time, global mine production has struggled to keep pace with total demand. This ongoing imbalance has created a structural deficit that has persisted for years. Every year, more silver is consumed than newly produced, forcing the market to draw from existing inventories. That is one of the main reasons many long-term investors remain focused on the physical story rather than day-to-day movements in interest rate expectations. For now, the key question is whether physical demand continues to strengthen as the next delivery cycle approaches. If inventory pressure increases while industrial demand remains strong, silver could find support regardless of short-term swings in monetary policy, and that is exactly why the next few trading sessions may be so important. Investors will be watching inventory data, delivery activity, treasury yields, and commodity markets for clues about which narrative is beginning to dominate. This is JHon Silver Update, and the next phase of this story could be even more important than what happened at today's Fed meeting. As we move into the final days before the next major market events, investors should focus less on predictions and more on what the data is actually showing. The market is entering a period where several important developments are converging at the same time, and together, they could determine silver's direction over the coming weeks. The first event is the formal completion of the Iran peace agreement. Markets have already reacted to the announcement, but official implementation is what removes uncertainty completely. Once a geopolitical risk is officially resolved, traders who are positioning for higher energy prices must reassess those positions. That matters because lower oil prices can have a direct impact on inflation expectations. If energy costs remain under pressure, the inflation concerns that supported today's hawkish Federal Reserve projections may begin to weaken. The longer crude oil stays below recent highs, the more difficult it becomes to justify expectations for tighter monetary policy far into the future. The second event is the upcoming COMEX First Notice Day. This is where attention shifts from economic forecasts to physical silver. Market participants will closely monitor inventory levels, delivery requests, and changes in open interest. These numbers often tell a more important story than headlines because they reveal what investors are actually doing with real metal. If inventory levels remain stable and delivery demand eases, the market may remain calm. However, if physical demand stays elevated while available supply tightens further, investors could begin paying much closer attention to the structural deficit story that has been developing for years. The third factor is the bond market. Treasury yields remain one of the clearest indicators of how investors are interpreting Federal Reserve policy. If yields begin moving sharply higher, it would suggest markets are embracing the Fed's hawkish message. If yields remain contained or move lower, it could signal that investors believe inflation pressures will continue to cool, despite today's projections. When you combine all of these pieces together, the picture becomes much more balanced than many headlines suggest. Yes, today's Federal Reserve communication leaned hawkish. Expected rate cuts disappeared. Policymakers projected a higher path for rates. Inflation was described as persistent, and balance sheet tightening remains a possibility. But despite all of that, silver remained remarkably stable. That may be the most important takeaway from this entire week. A market that survives negative news without breaking often sends a message of its own. It suggests buyers are willing to step in even when sentiment becomes cautious. It suggests confidence exists beneath the surface. And in silver's case, much of that confidence appears connected to the physical market rather than short-term monetary policy expectations. The long-term fundamentals have not changed. Industrial demand remains strong. Global supply challenges continue. New technologies require increasing amounts of silver. Mine production still struggles to fully meet consumption needs, and the deficit that has defined the market for years remains unresolved. That does not mean silver will move in a straight line higher. Volatility will continue. Pullbacks will happen. Markets rarely move smoothly, but the bigger picture remains focused on one question: can physical supply keep pace with long-term demand? As investors watch the next several days unfold, that may prove to be a far more important question than anything said during a single Federal Reserve press conference. For now, the Warsh era has officially begun. The Fed has delivered its message, the market has responded, and silver continues to hold its ground. The next chapter will be written by physical demand, inventory flows, energy markets, and investor behavior heading into the upcoming delivery cycle. This is JHon Silver Update. If you found this analysis valuable, make sure to subscribe, share your thoughts in the comments, and stay tuned because the next few days could provide some of the most important signals silver investors have seen all year.